Welcome back. So SoFi lately hasn't been very impressive as far as the stock goes for us investors. We had our doubts, they had it, and then the stock market is of course undecisive. 1 minute it's up, 1 minute it's down. So this video is one of the best video that I have shot recently. I mean, you can probably sense the enthusiasm in my voice because when I heard this interview with Piper Sandler and SoFi CFO and also Anthony Noto, nothing sort of extraordinary, nothing sort of amazing company and what they are doing. So I thought that I'm going to do something different in this video. Instead of me going over the interview and the points, which I will towards the end, I'm going to summarize it for you in like one sheet. Look, I had my kid's drawing. If you can see clearly, he made an airplane and I was just sitting here and taking notes when I was watching or when I was listening to the interview, because this interview is very good. They touched all the topics that I wanted to hear from SoFi. So this is really bullish, guys. This is my request. If you are driving, this is the best 20 minutes. If you're a SoFi investor, of course, this is the best 20 minutes you're going to spend driving. If you are working out, this is the best workout you're going to get for the next 23 minutes. And if you are just sitting and basically binge watching YouTube, this is the best 23 minutes you're going to spend. So let's do this. I'm going to play the entire interview. I'm not going to chop it off. I'm going to play the entire interview. It's your decision to watch the entire or listen the entire interview. Or if you want to come back, because at the end of the interview, I'm going to summarize it, what is being said, because it was a one sheet, it's a long sheet. I mean, if you can see, it's a one sheet document that I basically made when I was listening to the interview. Now, what I have done is, because this was an audio interview, I'm giving you the audio, but I have kind of overlaid it so you don't just see a dark screen. Their website clipping, it's nothing. So you can actually ignore the video, just listen to the audio or pay attention to the audio. But if you are watching the screen, look at their website, look at the values that they all strive for, because how often do we go to SoFi's website? Actually, I went to SoFi's website after a very long time, probably like after a month. And this was something different that I saw over there. So I'm gonna play that clip or that screen recording on top of the audio. But audio is what I want you to pay attention to. So take a listen.
To our afternoon session of the Global Exchange and Fintech Conference. Today I have the pleasure of introducing Chris Lapointe from SoFi. He's been SoFi now for four years, roughly 4 years, 2 years as a CFO, and what has been an incredibly eventful time for the company. Very busy, a lot going on. He went through a SPAC deal in May 2021, followed it up with the acquisition of Golden Pacific in February 2022, and then the acquisition of Technisys in earlier this year. So obviously a lot going on. The world has been navigating a pandemic. You're dealing with a student loan moratorium, and fintechs and neobanks have been under a lot of pressure lately. And SoFi is, swimming upstream and attempting to take share in that environment. Could you help us understand why SoFi is different than a lot of those neobanks and fintechs that have been under, significant pressure in the market today?
Yeah, absolutely. And thanks so much for having me, Kevin. Really appreciate it. So what I thought I could do is I could at least hit on our mission, talk a little bit about our strategy and key differentiators, and then we can go in any direction that you'd like. So overall, our mission at SoFi is to help our members achieve financial independence in order to realize their ambitions. When I say financial independence, I don't mean that the member needs to be rich. They need to have enough money to do what they want, to have the career that they want, to have the lifestyle that they want, to have the family that they want. And what we've done at SoFi in order to help our members achieve that independence is we've created a comprehensive set of products and solutions that enable them to borrow better, save better, spend better, invest better, and protect better. And we've done all of that by putting the members' interest first in every step along their financial journey and every day in between. And that's a really important competitive differentiator for us because we feel that our members have been left behind by legacy financial institutions who have focused on things and optimized for things that are outside the best interest of the members and what they want and need. So we've taken a different approach and we've developed a one-stop shop of products and services where our members can get their money right, and we've done so in a digital format. In order to further our mission, we have deployed a strategy that we call the Financial Services Productivity Loop. And that has three main components. The first one is creating a comprehensive set of products that are each and individually best of breed. And we work really hard to ensure that they are best of breed by differentiating each and every one of them across four key dimensions. fast, selection, content, and convenience. And in addition to that, we want each of those products to work better when they're used together. And the reason that that's really important is because when a member takes out one of our financial services products, we need to build that trust and loyalty with them such that when they need or want a second or third or fourth product, they think of and come to SoFi first. What happens at that point is the revenue per member increases dramatically. We don't have to pay a second customer acquisition cost, and it further helps our long-term goal of having the highest LTV in the industry. What that enables us to do is reinvest back into the business, back into the consumer in the form of better pricing, better products, better services. The second key element of our overall strategy is to have superior unit economics across each and every one of our products. And vertical integration is a key component of that. We've seen in our lending business where we're vertically integrated, we've built technologies and processes that enable us to iterate and innovate at a much faster clip and at a much lower cost, which provides us much more access to data and, again, allows us to provide a better service to our members. If we were able to have superior unit economics across each and every one of our products, again, we would be able to reinvest back into the consumer and into the business in the form of a better experience. And then the third component is investing in our Fintech platform in pursuit of becoming the AWS of Fintech. Back in May of 2020, we acquired the business Galileo because we fundamentally wanted to vertically integrate our checking and savings business in the same way that we did with our lending business. And it has certainly enabled us to iterate at a much faster clip and lower costs. But that business is a really good business in and of itself, high growth and high margins. What's even better is that as we innovate and iterate at SoFi, we're iterating and innovating at Galileo, which is in turn helping all of the consumers in rising the tide for all boats and ships and driving better adoption in the overall industry. So that's our mission, our strategy, and some of the competitive differentiators. The one last thing I would note there, and what's really helped from a differentiation perspective relative to some of the companies and peer set that you talked about, is that we have a very diversified business model where we have a whole host of products and services that perform better and or differently in different macro environments. That has provided us with a ton of durability and enabled us to deliver strong results over the last several quarters. And then on top of that, the quality of our member is extremely strong. If just two examples of that, our average personal loan borrower has an average weighted income of $140,000 and an average FICO of 746, and our average student loan refinancing member has an average weighted income of over $170,000 and an average FICO of 775.
I'd like to touch on that later, but just to follow up on what you talked about on your CAC, driving your CAC lower to drive new members. You've been growing persistently. I mean, your growth has been through the roof over the last several years and really accelerate, especially within the personal loan business. Mm-hmm. You recently bought the bank. You have a new deposit base. You also issued new guidance recently at first quarter earnings, where you implied that your Ebitda is going to ramp quite a bit throughout this year. In fact, probably, significantly after the second quarter. Could you help explain why you see that profitability really start to expand in the back half of this year?
Yeah, two main things are driving that. First is we do expect to see continued growth in our high margin personal loans business, which has been doing extremely well in a rising rate environment as people are looking to refi out of variable rate debt into fixed rate loans. So that business continues to do extremely well. We expect it to continue to do really well, and it has high margins. Similarly, on our Galileo business, which has high margins, 30%, right now we expect to see continued and sustained growth throughout the rest of the year. The second main component and one of the larger drivers is the fact that we now have access to the bank and the lower cost of capital. So in the back half of the year, you're going to start seeing a much more meaningful impact from the lower cost of capital of using our now high quality deposits that we've been able to raise through SoFi Bank, as well as an extended hold period. So prior to having the bank, we would originate a loan, hold it on our balance sheet for 3 months, and then sell. Now that we have a bank, we have the flexibility to originate the loan, hold it on our balance sheet for up to 5 to 6 months, and then sell. And we're seeing incremental gains on net interest income, which will be a large driver of that ramp in the back half of the year. But we're also not seeing any degradation in our gain on sale margins.
So how much interest expense are you saving versus your warehouse lines by utilizing the deposit base?
Yeah, so prior to having the bank, we had access to about $7 billion of warehouse capacity, and we would pay anywhere between 150 to 400 basis points, depending on the facility. And each of those facilities is variable in nature, such that as Fed funds increases, so does the cost of that capital. And then on the deposit side, we're offering an APY of about 1.25% for people who take out direct deposits. So the cost of capital savings that you're seeing between our deposits and the warehouse facilities today is north of 150 basis points.
Okay. And then you mentioned that the hold periods are longer as well, right? So you're retaining more NII. Are you seeing it? Would that impact your gain on sale that you're currently incurring, or potentially? Could you explain how that plays a part?
Yeah, we haven't seen a whole lot of degradation in the overall gain on sale margins. We've just started holding loans for a longer period of time, and the demand that we've had for our paper, both on the personal loans and student loan refinancing side, has been extremely strong and robust. So we're not seeing any degradation.
Okay, and then. So you also gave updated guidance when the student loan moratorium was extended into August. You took it out of 2022. I think by our estimates, it's worth roughly $100 million at Ebitda per year. Could you see that as an additional tailwind as we go into 2023? And do you expect the moratorium to expire in sometime in 2023, or what's your expectations there?
Yeah, so as you mentioned, what's baked into our overall 2022 guidance is that the moratorium does not expire and it extends throughout the rest of the year. We don't have any expectations for when it's actually going to expire. It's an evolving situation with new news and hypotheses every single day. So I don't want to comment on where we think that will go, but it will certainly, when and if it does expire, it will certainly be a tailwind to the business. What I would say, and what's consistent with what we talked about during the earnings call, is that we think we're going to be driving towards a 30% incremental Ebitda margin, in 2023 and beyond, because we think that that's the right level of investment that will enable us to drive top line growth for decades to come.
Yeah, so a ramp in the back half this year, and then potentially, if things were to develop on the student loan side, into 2023.
Correct.
Okay. And then, you often hear that higher interest rates are diminishing the potential impact there. Could you talk about how higher rates are impacting your potential margins? And obviously it's a topical item right now.
Yeah, absolutely. So what I would say in terms of the overall student loan market is there's about $1.7 trillion of debt outstanding today, with hundreds of billions of dollars of debt outstanding that's priced at a level that's far north of where we're able to price our student loan refinancings right now. And that's primarily a result of two things. We have a cost structural advantage as a result of being vertically integrated, and being able to offer better pricing relative to some of our monoline peers. And then second, by now having SoFi Bank, we're able to further strengthen that structural advantage that we have.
Okay, so touching on the bank, you mentioned, so there's driving lower funding costs, which is driving Ebitda growth. Could you just give us an update on how your progress on growing the deposit base? I believe you mentioned roughly a little over $1 billion in deposits as of the first quarter. It was growing at roughly $100 million per week. Could you give us any updates on where you are with the deposit side?
Yeah, we've seen a tremendous uptick in our overall deposit base, and we're really happy with the progress that we've been making there. So when we announced earnings a month ago, we had said that we were at about $1.5 billion of deposits and growing at around $100 million per week. This week, we're at about $2.2 billion of deposits right now at SoFi Bank, and we're still growing at that healthy clip of north of $100 million a week. So overall, really good progress. That's a really key element of our overall longer-term strategy. And we're also really happy with the progress that we've made on the direct deposit side. we've seen a significant uptick in terms of overall conversion. Our conversion rates for our direct deposit members have increased by 60% Q1 versus Q4. The overall average balance per direct deposit member has increased about 25% sequentially. And then we're seeing really good engagement trends where spend per money member or checking and savings member has increased as well sequentially.
That's a tremendous amount of growth on the deposit side. What is the main driver you're seeing there? Obviously, your rates, APY is a little bit higher than most of the peers, but your incremental cost, it's worth it to you because your incremental costs are lower. You just explain why you're generating such a tremendous amount of growth on the deposit side.
Yeah, I think it's a function of having an industry-leading APY with no restrictions. A lot of peers out there have high APYs, but they have balance restrictions. You can put $5,000 to get this APY, but after $5,000, that drops to X, Y, or Z. Our APY is 1.25% for all of our direct deposit members, and there's no limitation on the amount that they can deposit. So I think that's a key competitive differentiator. I think in addition to that is going back to the intro where I talked about having a diversified set of products and solutions that is very much unlike some of the monoline players out there.
Yeah, so you're driving, you have lower CAC on the deposit side to drive higher LTVs on other products that you're selling, right?
Exactly.
Yeah. Okay. Now you have more loans on your balance sheet versus loan sales to drive some of this revenue, right? So you're seeing, you're still able to retain that gain on sale margin. Why are you able to still maintain those types of margins even though you're holding the loan for a longer period of time?
Yeah, I think this comes back to the quality of our borrower that I mentioned at the beginning of the conversation. Like I said, the weighted average income of a personal loan borrower is $140,000 with a very high FICO of 746. In addition to that, we're seeing really good credit statistics. We publicly report our 90-day delinquencies. In Q1, those were at all-time low levels and had improved sequentially and year over year. And similar story on our annualized charge-off rates, which were at 1.04%, and that was an improvement year over year. So what we're seeing is really good trends in terms of loss rates and delinquencies, which is helping drive overall demand for the purchasers of our paper.
So a lot of others in the other installment lenders or student lenders or even credit cards are starting to see a little bit of degradation, specifically around the subprime side. You're obviously lending to higher FICO scores. Is there are you seeing anything else in the market that may be indicating that we're starting to see softness in the consumer or anything of the sort, or is it still fairly benign? I mean, you're showing year-over-year declines in your delinquency rates and default rates.
Yeah, we haven't seen it in our consumer base, and I think that's a function of the quality and the overall profile of our borrower. So we haven't seen any degradation up until this point, but we obviously closely monitor that along with a number of other macroeconomic factors that we're reviewing every single day and week to ensure that we're continuing to lend to the best borrowers.
Okay. One question we get a lot from investors is, maybe you've heard this a lot, is, hey, when are you going to be GAAP profitable, right? And I think a lot of people, we've just been hearing that a lot. Could you just help us understand the build up from EBITDA growth to GAAP profitability sometime in the future and how we get there?
Yep. Absolutely. So we certainly have a plan to get to GAAP profitability. It's a multi-stage approach. I'll walk through each of the stages just to give you a sense for how we're thinking about it and the progress that we've made up until this point. So the first stage was, and first step to the process was to become EBITDA profitable for a full year. We ended up doing that in 2021, which was a material improvement from the $220 million of losses that we had in 2018 and the $150 million of losses that we had in 2019. So we've made really good progress from an adjusted EBITDA perspective. To give you some of the building blocks to that, our lending business is highly profitable. We're delivering over 50% margins every single quarter. We also have a tech platform business that is profitable and generating 30% margins. Our financial services segment had contribution losses of about $50 million in the quarter. But what I would say is, if you go into the details and into our filings and dissect, some of the cost elements, and if you were to look at variable profits excluding marketing spend in that segment, we've actually been profitable for the last 3 quarters. And we expect to be profitable on a variable profit basis, including marketing, by the end of this year, so the end of 2022. The reason that that's really important, because at that point, it's more of a scale game, and you have to acquire more members that are delivering positive variable profit in order to cover your fixed costs. And we expect to be able to cover those fixed costs by the end of 2023 and become contribution profit positive exiting that year. So we're making really good traction there. And then the remaining pieces from EBITDA down to GAAP net income is you have unallocated or non-direct expenses. That's corporate overhead. We expect to see real operating leverage in that line item over the course of the next several years, as we've invested quite heavily in the prior years leading up to becoming a bank and building out a lot of our processes. We also have stock-based compensation of about $77 million in Q1. A third of that expense was attributable to performance share units, which were granted as part of our IPO process. And that expense is actually going to go away in Q1 of 2024. So if you were to exclude that expense, the overall stock-based compensation relative to revenue is in the 15.5% range, and we expect to get that down to single digits over the course of the next few years. So those are the main building blocks. We certainly see a path to profitability, but it's a multi-stage process.
So pretty consistent profitability within the lending segment, potential for operating leverage within the technology segment.
Yep.
What Ebitda margins are you targeting longer term there?
So right now, we are operating at a 20 to 30% margin in the near to medium term. We expect that business could be a 40% margin long term.
Okay, and then break even or close to it by the end of 23 within the financial services segment as you generate scale.
Exactly.
And operating leverage. Okay.
That's right.
So why should we think about EBITDA and cash flows right now as a better metric versus GAAP earnings?
Yeah, one of our main objectives is to create value for our shareholders and the company, and we view the best indicator of growing value and overall equity value, book value, is free cash flow, and that's what we're focused on delivering right now. If you were to actually look at an adjusted free cash flow of our business, you can't really see it in our filings because we're a financial services company. But if you strip out some of that noise between cash from operations and cash from financing, we're actually cash flow positive.
There's a lot going on there.
Yeah.
And a lot of momentum that's going on in quite a tough market. So, when you step back and, you take this into consideration and you're growing, you have all these different products that you've gone through a series of M&A, you've become a bank. Where do you see SoFi, 3 years, 5 years down the road? What does it look like? And, is there other products that we're not seeing? Is there something else there? What do you envision SoFi looking like 3 to 5 years from now?
Yeah, we're really excited about the position that we're in right now. What I would say longer term, we have aspirations to be a top 10 financial institution, and we have the recipe and the tool set to get there, and we want to be a very well-known brand. So call it 3 to 5 years from now, we expect, the overall revenue profile of the business to be about a third lending, a third tech platform, and a third financial services, with margin profiles, as you just described, of about 50+% in the lending business, 30 to 40% in the technology platform business, and then mid-20s to 30s in the financial services segment. What I would say is we've never been in a better position than we are today to navigate what appears to be a tough macroeconomic cycle. We ended up raising over $3.5 billion of capital last year to shore up our balance sheet. We now have access to low-cost deposits and funding. We have all of the table stake products necessary to enable our members to get their money right, and it's all coming down to execution for us over the next several quarters and years to realize our overall ambitions.
Okay. Well, Chris, we appreciate your time and wish you the most success. And thank you for joining us here at the Piper Sandler conference.
Awesome. Thank you so much. Really appreciate it.
Okay, so now tell me, was it good or was it good? This was amazing interview. They touched all the key points. So now what I'm going to do is I'm going to break down the points that CFO Chris basically touched at different intervals. And then we'll talk about what it means for us as SoFi investors. This is going to be a long video. It already is if you have watched those 23 minutes. But if you have skipped some part of it, don't worry, I'm here to break it down. Okay, so the average student loan income per borrower is 170K that we have heard from before. Average loan borrower yearly income is 140K with the average FICO score of 746, and for the student loan person, their FICO score is even higher. Okay, highest growth into home loan and those are high margins because people are refinancing the loan because the rates are going up. They are not buying the new homes, but they are basically taking the equity out and they are refinancing. So they have that product as a very high margin product for them. High growth with Galileo is what they expect in the coming years. Being a bank definitely will add to profitability in 2022 and 2023. Then student loan time frame. So they said that we have no expectation of student loan being resolved anytime soon. We already know that. In the earnings, I even came out and I said that SoFi has thrown out the student loan part completely. They are not paying attention to it. They are not waiting to realize the student loan into their books. So which was of course good to kind of see the reassurance that this is what they are also thinking. Next, deposits. This was very, very juicy. 1.5 billion is what they reported they have when they came out with the earnings just a month ago, right? May 11th is the earning and they came out and they said they have 1.5 billion in deposit. Guess how much deposits they have now? Now they have 2.2 billion of deposit. That means 100 million plus is what weekly inflow in their bank, as SoFi as a bank. This is really bullish. $2.5 billion in deposits they already have. That means they can continue making high profitable loans to their folks or to the consumers as they go forward. Okay, next, consumer. So they were saying that there is some other banks. This is the interviewer who asked, Piper Sandler folk, who asked, is it, okay, consumers' confidence is low and they are seeing some degradation in other banks. Are you also seeing that? To that, Chris responded, we are not seeing any consumer degradation in our books or so far, but they are, of course, monitoring the situation as they go. Then he asked, when will you be GAAP profitable? Which is, of course, a very important question. They are EBITDA profitable, but when will they be GAAP profitable is what Piper Sandler person asked. They're saying that we have a multi-stage approach to be GAAP profitable. Basically, their first stage was they wanted to be a EBITDA profitable for a full year, which they did in 2021. So they met that. The next steps is basically they wanna, or stage 2, stage 3 is when they will achieve the GAAP profitability. Then stock-based compensation. This was very interesting. So what they are saying is they have performance-based stock-based compensation, and they're saying that 15% stock-based compensation by 2024, and they will further reduce it or bring it down in the Q1 of 2024. So the stock-based compensation that we see right now is going to go down, which is again a very positive and also a very bullish sign. Next, EBITDA margin, 40% margin long term, which is a very bullish sign. So now we have seen this pieces of information or this kind of numbers in their earnings report in their presentation deck. We have seen it time and again. But for them to come out and make these statements with an investor in current market condition is very bullish in my opinion. So this was a really good interview for me personally. I enjoyed every minute of it. If you have not listened to the whole thing, I would appreciate if you're an investor, of course, and if you care about the company, to go back and listen to this interview one more time because this is amazing. This is pretty good actually. Okay. So then the person asked $1 million question that we all want to know. Where do you see SoFi 3 to 5 years from now? This was a very important question. And I feel like the Piper Sandler person was like talking from our behalf, because that's what we want to know too, that where do they see themselves in 5 to 10 or 3 to 5 years from now? Okay, they would like to be in the top 10 financial institutions in the next 3 to 5 years. This is an aggressive goal, top 10 financial institution. They want to be a well-known brand, and they want to be basically leading in all sectors, which is tech, lending, and financial services. Then Chris basically further broke down of how they see profitability in these sectors. Here's what they're saying. In the lending segment, they would see themselves as 15% profitability in the lending segment. In tech, which is Galileo and Technisys, 30 to 40% margins. Okay. Then in financial services, 20 to 30% margins. So 15% from the lending, 30 to 40 from the tech, and 20 to 30 from financial services. This is how they envision SoFi in the next 3 to 5 years. Right now, they are not GAAP profitable. Once they turn GAAP profitable, this company or the stock price is going to go through the roof. Now you know why. Because I say that, something is cooking in SoFi, and that's why they are just insiders are buying. Now, is this something cooking? No, they have a game plan. They have a multi-stage approach, which they are basically taking, and they have successfully taken two. Number one was to be EBITDA profitable for a whole year, which they did in 2021. Number two was they're saying that they want to be a bank, or they wanted to be a bank, which they also acquired. So now they have the deposits. Now they are a bank. Now they have everything that they need to basically successfully operate in their multi-step approach of being GAAP profitable by 2024. And that's going to be massive. So does it mean that the stock is not going to go down? Of course it's going to go down in the short term, because stock trades in the market. But if you are a short-term trader, you're better off basically investing in any other company, because this company is not going to give you the return that you expect in the next 3 months, but this company will give you the return that you deserve in the next 3 years. That's my opinion. 3 to 5 years is my horizon too with this company, if everything goes as per the plan. See, when a company, or even when people like this from a company, they come out and they give these kind of interviews, it does two things. Number one is that they're not shying away from publicly coming out and basically voicing what they feel and what they think is going to work for their company, right? 2.5 billion in the deposits. That's a huge amount for a young bank, for a company who just turned bank, and they're attracting so many new members. Along with that, they also mentioned, if you listen to the interview, they also mentioned that their cross-sell, which I keep repeating myself in every earning, that if they gain 500,000 members, that doesn't mean they gain 500,000 members. That means they gain 700,000 members, because their cross-sell is very impressive. So I'm very excited, very bullish to listen to this interview and, of course, what these people have to say. Now, again, it's not, if I make a video that, hey, why are they doing the reverse split, doesn't mean that I don't believe in the company. I have over $250,000, even more, invested in SoFi. So I'm going to ask tough questions, of course, because that's my responsibility as an investor, and that's why you watch this channel. I'm not going to just come in and keep saying good things about it. If I see something weak, I'm not going to be happy about it. But this was really positive. This was really good, and that's why I think it deserved to be appreciated. It deserved to be brought in front of everybody like you and me. And basically, we should congratulate the company for coming out and giving us details that we wanted to hear. So good job, SoFi. And of course, if you have any comments, let me know in the comments below about this interview. What do you feel? What do you think? And also, please hit the like button. Please subscribe to the channel and share this video with your friends and family, those who are into the SoFi stock, because this is definitely something that you and I should listen to and should watch. Thank you so much for tuning in. Until next time, you all, as SoFi said, keep smiling and have a sparkling day. Take care.